Look at this chart. This is U.S. economic growth over the past 150 years. See those peaks and valleys? Those aren't random. There's a pattern here that nobody in mainstream economics wants to talk about. Economic expansions in the United States tend to last about 7 to 10 years. Then they crash. Then the cycle starts again. And it's been happening with irregularity since the Industrial Revolution began. 1873 crash. 7 years later, recovery begins. You can set your watch by these crashes. And yet, every single time one happens, economists act surprised. Nobody could have seen this coming, they say. This was an unprecedented black swan event. Federal Reserve chairs give testimony to Congress acting confused about what went wrong. Financial media brings on experts who claim the warning signs weren't there. Except it's not unprecedented. It's a pattern. And the 7-year rhythm isn't coincidence. Here is what's really going on. There is a fundamental structure to how modern capitalism works that creates these cycles. It's not about psychology. It's not about external shocks like wars or pandemics. It's not about regulatory failure or bad actors. Those things can trigger crashes, but they don't explain the timing. The timing comes from something deeper, something built into the system itself. And the people who understand this pattern, they've been making fortunes off it for over a century by positioning themselves ahead of the crash while everyone else is buying at the peak. Warren Buffett, Ray Dalio, George Soros, these aren't just lucky investors. They understand cycles. They understand timing. They know when the system is in late cycle fragility, even when everyone else is celebrating new highs. But here's what'll really blow your mind. The 7-year cycle isn't new. It's not a feature of modern capitalism. It shows up in ancient texts and biblical law, even in agricultural societies that had no concept of stock markets or central banks. The 7-year pattern appears to be something deeper than economics, something about how human systems organize themselves over time. Some researchers think it might be connected to solar cycles. Others think it's about generational memory, how long it takes for people to forget the lessons of the last crash. Some even argue it's hardwired into human psychology somehow. But I'm going to show you something different. I'm going to show you the mechanical reasons. Why economies become vulnerable to crashes every 7 years. Not mystical reasons. Not psychological reasons. Actual structural mechanisms that you can measure and predict. Let me show you how deep this goes. Let's start with the data because if you're skeptical right now, you should be. Extraordinary claims require extraordinary evidence. And the claim that economic cycles follow a predictable 7-year rhythm sounds like something from a conspiracy theory forum. So let's look at the actual numbers. The National Bureau of Economic Research tracks business cycles going back to 1854. They define recessions and expansions based on multiple economic indicators: employment, production, retail sales, industrial output. This isn't subjective, it's data. According to their records, the average length of economic expansions in the U.S. since 1854 is 45 months. That's about 3.75 years. So immediately, you might think, wait, you said 7 years. This data says less than 4 years. You're wrong. But here's where it gets interesting. That average is being pulled down by a bunch of very short expansions that happened in the 19th and early 20th centuries. Back then, you get these rapid boom-bust cycles, 2 years up, 1 year down, repeat. The economy was much more volatile. If you look at the period from 1945 to present, the era of modern managed capitalism with central banks actively trying to smooth out cycles, the average expansion length jumps to about 65 months. That's 5.4 years. Much closer to our 7-year pattern. And if you remove the very short expansions, the ones that lasted less than 2 years and were more like brief recoveries and full cycles, the average jumps to about 78 months. That's 6.5 years. But averages hide patterns. Let's look at the actual major boom-bust cycles that reshaped the economy. The expansion from 1991 to 2000, 120 months. 10 years. Then the dot-com crash wiped out trillions in market value. The expansion from 2001 to 2007, 73 months. Just over 6 years. Then the housing crisis nearly destroyed the global financial system. The expansion from 2009 to 2020, 128 months. Nearly 11 years, the longest expansion in recorded U.S. history. Then COVID hit, and we had the fastest crash in history, followed by the most aggressive monetary intervention in history. Go further back. The Roaring Twenties boom from 1921 to 1929, 96 months, 8 years. Then the Great Depression. The post-war boom from 1961 to 1969, 106 months, almost 9 years. Then the 1970s stagflation. The Reagan expansion from 1982 to 1990, 92 months, almost 8 years. Then the savings and loan crisis and recession. The Clinton expansion from 1991 to 2000, 120 months, 10 years. Then dot-com bubble burst. See the pattern? The major cycles, the ones that really matter, that reshape industries and create or destroy fortunes, cluster around 7 to 10 years with remarkable consistency. And this pattern shows up in other countries too. The UK has similar cyclical behavior. Germany, Japan, France, Canada. Even developing economies show boom-bust cycles in the 7 to 10 year range, once they develop sophisticated financial systems. Now, mainstream economists acknowledge that business cycles exist, but they frame them as irregular, unpredictable, and caused by different unique factors each time. They'll tell you the 1973 crash was caused by the oil crisis. The 2008 crash was caused by subprime mortgages. The 2020 crash was caused by a pandemic. Each crash gets its own unique explanation, which makes it seem like these are isolated incidents that couldn't have been predicted. But what if those are just triggers? What if there's an underlying structural reason that economies become vulnerable to crashes every 7 to 10 years? And these external events, oil shocks, housing bubbles, pandemics, just expose that vulnerability. Think about it like this. Imagine a house with structural problems. The foundation is slowly cracking. The support beams are weakening. But the house stays standing for years because nothing tests it. Then one day, there's an earthquake. Not even a big earthquake. Just enough to expose the weakness. And the house collapses. You could say the earthquake caused the collapse. And technically, you'd be right. But the real cause was the structural weakness that had been building for years. When an economy starts recovering from a recession, debt is low, and I mean genuinely low. Because the crash just forced a massive deleveraging. Companies that couldn't service their debt went bankrupt during the crash. Their debts were written off. Consumers who were overleveraged lost their homes through foreclosure, or declared bankruptcy and had their debts discharged. Banks that made too many bad loans failed, and their loan portfolios disappeared. This process is brutal, but it accomplishes something important. It purges bad debt from the system. It's like a forest fire that clears out dead wood and makes room for new growth. So at the beginning of an expansion, you've got a relatively clean slate. Debt levels are manageable. The survivors, companies, and individuals who made it through the crash typically have strong balance sheets. This creates opportunity, because at the same time debt is low, interest rates are also low. The Federal Reserve typically cuts rates aggressively during recessions to stimulate borrowing. And demand for loans is weak because everyone's scared from the recent crash, which keeps rates low even as the economy starts recovering. So, you've got this perfect environment, low debt, low interest rates, and huge opportunities because the crash destroyed a bunch of competitors and left market share up for grabs. Smart businesses and individuals recognize this moment and act on it. Companies take out loans to expand production, open new locations, invest in technology, hire workers. Consumers take out mortgages to buy houses at depressed prices. Entrepreneurs launch new ventures. For the first few years, this works beautifully. The borrowed money gets deployed into productive activities. New factories actually produce goods that people want to buy. New houses provide shelter for growing families. New businesses create jobs and generate revenue. This creates a virtuous cycle. Businesses borrow and invest, creating jobs. Workers earn income and spend it, creating demand. Rising demand justifies more business investment. More investment creates more jobs, round and round. By year 3 or 4 of the expansion, things are really humming. Unemployment is falling. Wages are rising. Asset prices, stocks, real estate are climbing. Everyone feels wealthier. Consumer confidence is high. But here's where the 7-year clock starts ticking. Debt accumulates faster than income grows. Let's trace this through a specific example. Imagine a manufacturing company in year 1 of the expansion. They borrow $10 million to build a new factory. The loan is a 10-year term at 5% interest. Their monthly payment is about $106,000. In year 1, their revenue is $20 million annually. That debt payment is manageable. It's only about 6% of revenue. By year 3, things are great. Revenue has grown to $35 million. That same debt payment is now only 3.6% of revenue. They're crushing it. So they borrow another $15 million to expand even more. By year 5, revenue is $50 million, but now they're servicing $25 million in total debt. The payments have grown to about $265,000 per month, still manageable at about 6.4% of revenue. But notice what's happening. Debt is growing faster than revenue. By year 7, revenue growth is slowing. They're at $55 million. Only 10% growth compared to the 40 to 50% growth they were seeing in early years. Why? Because markets saturate. They've already captured most of the available customers. Competition has increased as other companies made similar investments. But the debt payments haven't slowed. They're still paying $165,000 per month. And some of those early loans are coming due, which means they need to refinance or pay them off. This is where things get dicey. If they can refinance at similar rates, fine. But if interest rates have risen, which they often have by year 7 of an expansion, because the Fed has been gradually raising rates to prevent overheating, the new loans are more expensive. Suddenly, the company is spending 8% or 9% of revenue on debt service. Profit margins compress. They need to cut costs or borrow more just to maintain operations. And here's the critical thing. This isn't happening to one company. It's happening across the entire economy simultaneously, because everyone started borrowing at roughly the same time. Early in the expansion, when rates were low and opportunities were obvious, everyone hits their debt ceiling at roughly the same time. By year 7 or 8 of an expansion, you've got companies that can't grow without taking on more debt, but who are already heavily leveraged. Consumers who are maxed out on credit cards, car loans, and mortgages. Banks that are starting to worry about default rates because they see borrowers struggling. Asset prices that have risen far beyond what fundamentals justify because cheap debt inflated everything. The system becomes fragile. It doesn't necessarily crash at this point, but it's vulnerable. All it takes is a trigger, rising interest rates, an external shock, a sudden loss of confidence, and the whole thing unravels. A few companies start missing debt payments. Banks become more cautious about lending. Credit tightens. Companies that were depending on rolling over their debt suddenly can't get new loans. They start laying off workers. Unemployed workers stop spending. Demand falls, more companies struggle, more layoffs, downward spiral. This is why the timing is so consistent. The debt accumulation cycle takes about 7 years to run its course. From clean slate with room to borrow to everyone's maxed out and vulnerable. It's not mystical, it's mathematics. Compound interest plus slowing revenue growth equals crisis. But the debt cycle isn't the only factor. There's another structural reason why booms last about 7 years. And it has to do with how long it takes for investments to mature and show returns. When a recession ends, opportunities are everywhere. Companies that survive the crash are sitting on cash. Venture capitalists have dry powder. Private equity firms are looking for deals. And because asset prices crashed, everything is cheap. Smart money deploys capital into new ventures. These aren't instant successes. Real businesses take years to build. Let's trace a typical startup trajectory in the tech sector. Because tech moves fast, other industries take even longer. Year 1, startup phase. The company has an idea and some seed funding. They're building the product, assembling the team, figuring out the business model. They're burning through cash and generating minimal revenue. They're losing money. But that's expected. Year 2, early growth phase. Product launches, early customers come on board. Revenue starts flowing, but it's still small compared to costs. They raise a Series A or Series B round, still losing money. But revenue is growing 100% or 300% year over year. Investors are excited. Year 3 to 4, scaling phase. Revenue is increasing rapidly. They're hiring aggressively, expanding to new markets. Maybe starting to approach profitability, or at least showing a clear path to profitability. The business model is validated. This is when the company starts getting serious attention. Year 5-6, maturity phase. Revenue growth is still strong, but slowing from 300% to maybe 50% or 100%. The company is actually profitable now, or very close to it. They're considering an IPO. Investors who got in early are sitting on massive paper gains. Year 7 to 8, saturation phase. The company is mature. Revenue growth is slowed to 20% or 30%. The market they're targeting is getting saturated. Competitors have copied their innovations to maintain growth. They need to either expand into new markets, which is expensive and risky, or acquire other companies also expensive. This timeline shows up over and over again. Amazon was founded in 1994 and didn't turn its first annual profit until 2003, 9 years. Google was founded in 1998 and IPO'd in 2000 for 6 years. Facebook launched in 2004 and IPO'd in 2012, 8 years. The timeline varies by industry. Software companies can move faster. Manufacturing and infrastructure companies take longer. But the general pattern holds. It takes 5 to 8 years for a new venture to go from startup to mature business. Now, why does this matter for economic cycles? Because at the start of an expansion, there are tons of good investment opportunities. Promising startups that need funding, established companies that need capital to expand, real estate developments that make economic sense, infrastructure projects with clear returns. Investors deploy capital into these opportunities expecting returns in 5 to 7 years. And for the first few years of the expansion, new opportunities keep appearing. There's always another promising startup, another undervalued asset, another market to enter. But by year 6 or 7, something changes. Most of the obvious opportunities have been exploited. The startups that got funded in year 1 or 2 are now mature companies. The real estate that was cheap early in the cycle is now expensive. The infrastructure that needed building has been built. This creates a problem for investors. They still have capital. That needs to be deployed. Pension funds need returns to pay retirees. Endowments need returns to fund operations. Wealthy individuals need returns to maintain their wealth. But where do you invest when all the good opportunities are already taken? This is when stupid money starts flowing, when investment discipline breaks down. When projects that would never have been funded early in the cycle suddenly seem reasonable, because there's nowhere else to put capital. The dot-com boom is a perfect example. In the mid-1990s, the internet was genuinely revolutionary. Smart investors funded companies like Amazon, eBay, and Google that had real business models. These were good investments, but by 1999, 7 years into the expansion, the obviously good internet companies had already been funded, yet there was still massive amounts of capital looking for returns, so investors started funding ridiculous companies. Pets.com was going to revolutionize pet supply retail by shipping heavy bags of dog food across the country at a loss. Webvan was going to replace grocery stores by delivering groceries on demand. KOZMO.com would deliver DVDs and snacks to your apartment within an hour. None of these business models made economic sense. They were all subsidizing consumer purchases with investor capital. But in 1999, with years of gains behind them and no obvious alternatives, investors funded them anyway. Same pattern in the housing bubble. In 2002-2003, there were genuinely good investments. In real estate, certain markets were undervalued. Certain development projects made sense. But by 2006, 7 years into the expansion, investors were funding condo developments in markets that were obviously oversupplied. They were buying mortgage-backed securities, filled with loans to people with no income verification. Same pattern in crypto. In 2017-2018, there were interesting blockchain projects with real potential. But by 2021, coming off the 2020 crash, about 7 years of easy money since the last major deleveraging into 01 for to 015. This isn't irrational exuberance, or rather, it is irrational exuberance. But it's predictably irrational. It's the inevitable result of a system where 1. Capital accumulates faster than productive. Investment opportunities can be created to. People who control capital have a fiduciary duty to deploy it. 3. Returns from earlier investments need to be reinvested. For this process takes about 7 years to exhaust obvious opportunities. By year 7 or 8 of an expansion, you've got enormous amounts of capital chasing diminishing returns. Investors have to choose between accepting lower returns or taking bigger risks. Most choose bigger risks because their competitors are taking bigger risks and showing better returns, at least on paper. This capital misallocation is the other half of the fragility equation. It's not just that debt is accumulated. It is that a lot of that debt funded projects that will never generate sufficient returns to service it. Now here's where this gets really interesting, and why I think the 7-year pattern might be deeper than just modern financial mechanics. The Hebrew Bible, written thousands of years ago, prescribes something called the sabbatical year. Shemitah in Hebrew, every 7th year, according to biblical law. Several things are supposed to happen. First, all debts are forgiven. If you owe money, that debt is canceled in the 7th year, completely wiped out. You don't owe anything anymore. Second, indentured servants go free. If you sold yourself into service to pay off debts, you're released in the 7th year. Third, agricultural land lies fallow. Farmers are supposed to let their fields rest. No planting, no harvesting. Whatever grows wild can be taken by anyone, rich or poor. This wasn't just religious idealism. This was actual economic policy in ancient Israel and Judah, and it served very specific functions. Let's start with debt forgiveness and an agricultural economy without debt relief. Here's what happens. A farmer has a bad harvest. Maybe there's a drought. Maybe locusts destroy the crops. Whatever the reason, the farmer doesn't have enough grain to both feed his family and plant next year's crop, so he borrows grain from a wealthier neighbor. I'll pay you back after next harvest, plus interest. Next year comes. The harvest is okay, but not great. The farmer can pay back most of the loan, but not all of it. He borrows more to cover the shortfall. This continues year after year. The debt compounds. Eventually, the farmer can't possibly pay it back. According to ancient law, he has two options: sell his land to pay the debt, or sell himself and his family into indentured servitude. Either way, he loses his independence. The land concentrates in the hands of wealthy creditors. Small independent farmers become landless. Laborers, this process creates massive inequality and social instability. You end up with a small class of wealthy landowners and a large class of poor laborers who have no stake in the system. That's a recipe for revolution. The sabbatical year reset prevented this. Every 7 years, debts were canceled. The farmer who'd accumulated unpayable debts got a fresh start. Land that had been foreclosed upon was supposed to return to the original family. Indentured servants went free. The system hit a reset button every 7 years. Now, you might think, this is just ancient superstition, weird religious law that has no relevance to modern economics. But consider this: agricultural societies around the world operating independently discovered through trial and error that leaving land fallow periodically improved long-term yields. If you farm the same land continuously without rest, the soil gets depleted, nutrients run out, pests and diseases build up, yields decline. But if you let the land rest for a season or year, the soil regenerates, natural processes restore nutrients, pest populations decline. The next planting is more productive. The 7-year cycle wasn't arbitrary. It was based on observation of how natural systems work, how long it takes for depleted systems to regenerate. And debt accumulation follows surprisingly similar patterns. Let debt run for 7 years and you get dangerous concentrations of obligation. You get debtors who can never escape. You get creditors with excessive power. You get fragility built into the system. The ancient Israelites recognized this pattern and tried to manage it intentionally. They built the reset into their legal code. Modern capitalism doesn't have a planned sabbatical year, but it has an unplanned one, the crash, every 7 to 10 years. The system purges bad debt through bankruptcy, foreclosure, and default. Companies that took on too much debt go bankrupt. Their debts are written off or restructured. Homeowners who borrowed too much lose their houses. Through foreclosure, the mortgages are discharged. It's brutal and chaotic, but it serves the same function as the ancient debt jubilee. It resets the system. It clears out the accumulated obligations that can never be repaid. It makes room for new growth. The difference is that the ancients recognized the pattern and tried to manage it. We pretend it doesn't exist and act shocked every time it happens. We've convinced ourselves that with proper monetary policy and financial regulation, we can eliminate the cycle. We can have continuous growth without crashes. We can accumulate debt indefinitely, without consequences, but 150 years of data says otherwise. The cycle persists, 7 to 10 years of expansion, then crisis, then reset, over and over. Maybe the ancients understood something we've forgotten, that systems need periodic renewal, that accumulation needs periodic release, that you can't borrow from the future indefinitely without eventually paying the bill. The 7-year pattern might not be a bug in the system, it might be a feature of how all human economic systems work over time. So if this pattern is so obvious, if you can literally see it in 150 years of economic data, why don't more people talk about it? Why does every crash come as a surprise to economists, policymakers, and financial media? Because acknowledging the pattern would require admitting that crashes are inevitable. And our entire financial system is based on the pretense that growth can be infinite, and crashes are aberrations. Think about the incentives here. If the Federal Reserve came out and said, "We believe crashes happen on a predictable 7 to 10 year cycle," and there's not much we can do to prevent them. What would that do to consumer confidence? Would you take out a 30-year mortgage in year 6 of an expansion if you knew a crash was probably coming in the next 2 years? Would you invest your retirement savings in stocks if you knew the market was late cycle? Would you start a business if you thought a recession was around the corner? No. You'd hoard cash. You'd wait for the crash. You'd time the market. And if everyone did that, the economy would collapse immediately. Because modern economies run on confidence and credit. If people stop spending and borrowing, demand disappears, companies lay off workers, unemployment rises. It becomes a self-fulfilling prophecy. So the Fed has to project confidence. They have to pretend that with the right policies, they can maintain stable growth indefinitely, even though they can't, even though they've never been able to prevent crashes. Look at the statements from Federal Reserve chairs before major crashes. Ben Bernanke in 2007. We believe the effect of the troubles in the subprime sector on the broader housing market will likely be limited. 6 months later, the global financial system nearly collapsed. Alan Greenspan in 1999, the evidence suggests that we are dealing with a structural change in the economy. He was arguing that the dot-com boom represented a new paradigm. A year later, trillions of dollars in market value evaporated. Janet Yellen in 2017, would I say there will never, ever be another financial crisis? You know, probably that would be going far. But I do think we are much safer, and I hope that it will not be in our lifetimes. And I don't believe it will be. 3 years later, March 2020 happened. They're not lying exactly. They genuinely believe they can manage the cycle. But they are also institutionally incapable of acknowledging the pattern, because doing so would undermine their authority and destabilize the system they are trying to manage. The same thing applies to financial media. CNBC, Bloomberg, the Wall Street Journal. Their business model depends on people staying invested and engaged with markets. If they constantly reminded viewers that crashes happen every 7 to 10 years, and we are currently in year 8, people would tune out or pull their money out. So instead, every expansion is presented as potentially unlimited. This bull market could run for years. Becomes the narrative. Even in year 9 or 10 of an expansion, they focus on positive data points. They interview optimistic analysts. They downplay warning signs. Then when the crash comes, they act shocked. They blame external factors. They interviewed the same analysts who were bullish 6 months ago, now explaining why the crash was inevitable in hindsight. It's not a conspiracy. It's just aligned incentives. Everyone benefits from perpetuating optimism, right up until the moment it all falls apart. But sophisticated investors, they absolutely understand this pattern. They just don't talk about it publicly. Ray Dalio has written extensively about debt cycles. His book Principles for Navigating Big Debt Crises documents these patterns across multiple countries and centuries. He's built his entire investment approach around understanding where we are in the cycle. His firm, Bridgewater Associates, has earned billions by positioning for late cycle dynamics. They famously made money in 2008 when most hedge funds were collapsing, because they understood the debt accumulation pattern had reached a breaking point. Warren Buffett has a famous saying, be fearful when others are greedy and greedy when others are fearful. That's another way of describing cycle timing. And late expansions when everyone's optimistic. Get defensive. After crashes when everyone's panicking, get aggressive. Berkshire Hathaway's cash position is a good indicator of where Buffett thinks we are in the cycle. In 2008, right after the crash, Berkshire deployed massive amounts of capital into deals like Goldman Sachs and Bank of America. That generated enormous returns. By 2019, late in the expansion, Berkshire was sitting on over $120 billion in cash. They couldn't find good investments at late cycle valuations, so they waited. George Soros built his fortune by understanding reflexivity, the idea that market participants' perceptions influence fundamentals, which then influence perceptions in a feedback loop. This is basically another way of describing how late cycle dynamics work. Optimism drives borrowing and investment, which drives growth, which drives more optimism, until something breaks the cycle. Private equity firms and hedge funds have entire research teams dedicated to timing these cycles. They know that the best returns come from buying assets after crashes and selling them late in expansions. Their whole business model is cyclical. Blackstone, KKR, Apollo, these firms raise massive amounts of capital after crashes when assets are cheap. They buy distressed companies' real estate portfolios and infrastructure assets at depressed valuations. They hold for 5 to 7 years while the economy recovers. Then they sell or take companies public late in the next expansion when valuations are high. This is why private equity funds have time horizons of 7 to 10 years. It's not arbitrary. It's designed to capture one complete cycle. So, retail investors, regular people trying to save for retirement, get told to stay the course, and timing the market beats timing the market. And you can't predict crashes, which is all true to an extent. You can't predict the exact day a crash will start. But you can recognize when the system is in late cycle fragility. You can see when debt levels suggest vulnerability. You can notice when investment returns require ever greater risk-taking. And if you understand the 7-year pattern, you can at least be psychologically prepared for the inevitable crash. You can avoid getting caught up in late cycle euphoria. You can resist the temptation to go all in at the peak. So, where are we in the cycle right now? This is what everyone wants to know, right? When's the next crash coming? And this is where it gets complicated, because the 2020 crash didn't follow the normal pattern. Typically, crashes purge bad debt from the system. Companies that are over-leveraged go bankrupt. Their debts are written off. Consumers who can't service their mortgages lose their homes. Banks that made too many bad loans fail. It's brutal, but it clears the system. The 2020 crash didn't do that. COVID hit in March 2020. Markets crashed hard and fast. The S&P 500 dropped 30% in about a month. But then governments and central banks stepped in with unprecedented stimulus. The U.S. government sent checks to households, extended unemployment benefits, provided loans to businesses through the PPP program. The Federal Reserve cut interest rates to zero and bought trillions of dollars in bonds and mortgage-backed securities. Other central banks did similar things. This prevented the normal debt purge from happening. Companies that probably should have gone bankrupt were kept alive by cheap loans and government support. Homeowners who couldn't pay mortgages got forbearance. Banks didn't fail because the Fed backstopped everything. In some ways, this was good. It prevented the kind of cascading collapse that happened in 2008-2009. Employment spiked, but recovered quickly. The economy bounced back faster than anyone expected. But it also meant that the bad debt didn't get cleared out. It's still there. Zombie companies that aren't really profitable, but can service their debt at near zero interest rates, overvalue real estate, asset bubbles in stocks, crypto, and other markets inflated by stimulus money. So the question is, are we in year 5 of a new cycle that started in 2020? Or are we still in an extended version of the expansion that started in 2009? If we're in year 5 of a new cycle starting from 2020, that would suggest vulnerability around 2026 to 2028. The debt accumulation pattern would be reasserting itself. Early borrowers would be hitting refinancing walls. Markets would be getting saturated. But if we're actually still in an extended version of the 2009 to 2020 expansion, just interrupted briefly by COVID, then we might be in year 15 or 16 of the cycle, which would make us extremely overdue for a major deleveraging. The debt numbers suggest serious fragility. U.S. federal debt is at record levels as a percentage of GDP. Corporate debt is at record levels. Household debt is climbing. Student loans, auto loans, credit card debt, all at or near all-time highs. Asset prices are at valuations that historically precede major corrections. The stock market's price-to-earnings ratio is in the same range it was in 1929, 2000, and 2007, right before major crashes. Real estate in major cities is a price-to-income ratios that exceed the 2006 housing bubble peak. Junk bonds, debt issued by risky companies, are trading at yields that suggest investors aren't demanding much compensation for risk. That's a classic late-cycle signal. The smart money is getting cautious. Warren Buffett's Berkshire Hathaway has been building up cash reserves. They're sitting on record amounts of uninvested capital. That's what Buffett does when he can't find good investments at reasonable valuations. Credit default swap spreads have been widening. That means the cost of insuring against corporate defaults is rising. Market participants are getting more worried about credit risk. But here's what makes timing difficult. Central banks can extend cycles beyond their natural lifespan by keeping interest rates artificially low and buying assets. The 2009 to 2020 expansion lasted 11 years, partly because the Fed kept monetary policy extremely loose for most of that period. They might try to do it again, keep rates low, buy assets, do whatever it takes to prevent a crash, and they might succeed for a while. You can extend a cycle, you can smooth it out, but you can't eliminate it entirely, because the fundamental dynamics remain. Debt accumulates faster than productive investment opportunities can be created, eventually. Borrowers can't service the debt, eventually. Lenders get nervous, eventually. Something triggers a reassessment of risk. The longer you delay the reset, the bigger the imbalances become and the more violent the eventual correction. Japan tried this in the 1990s after their bubble burst. They kept interest rates at zero for decades. They prevented major debt write-offs. They propped up zombie banks and companies. Result: 3 decades of stagnation. They avoided the sharp pain of a crash, but they got chronic low growth instead. The U.S. might be heading toward a similar situation, not necessarily as extreme as Japan's lost decades, but a period of persistently low growth punctuated by financial crises that get papered over rather than fully resolved. Or we might get a traditional crash, some trigger, whether it's a geopolitical crisis, a financial institution failure, a commercial real estate collapse, or just a sudden loss of confidence, exposes the underlying fragility. Credit freezes. Markets crash. The system purges the accumulated debt. I can't tell you exactly when it will happen. Nobody can. The 7-year pattern isn't a crystal ball. It's a structural tendency, not a law of physics. What I can tell you is that if you believe the current configuration can continue indefinitely, you're ignoring centuries of historical evidence. The 7-year economic cycle isn't a conspiracy theory. It's not astrology. It's not mysticism. It's a pattern that emerges from the mechanical operation of debt-based economies. Debt accumulates over 5 to 7 years, until the system becomes fragile. Investments made early in the cycle mature and stop generating exceptional returns. Capital flows into progressively riskier assets as good opportunities get exhausted. Some trigger eventually exposes the vulnerability, and the system corrects. This has happened over and over again. For more than 150 years, it happened before central banks existed. It happened before sophisticated financial regulation. It happens in different countries with different economic systems. It even happened in ancient agricultural societies. The pattern exists because it's fundamental to how credit cycles work. You can't borrow from the future indefinitely. Eventually, the accumulated obligations need to be serviced or defaulted on. Eventually, borrowed growth needs to be paid back. Understanding this doesn't mean you can time the market perfectly. You can't pick the top or the bottom with precision, but you can recognize when the system is in late cycle fragility, when debt levels are elevated, when asset prices have divorced from fundamentals, when stupid money is flowing into obviously bad investments. Those are the signs that the clock is running out on the current expansion, and they're remarkably consistent across history. The people who understand this don't try to avoid the cycle. They can't. It's bigger than any individual. What they do is position themselves appropriately for each phase. Early in expansions, they deploy capital aggressively, buy assets while they're cheap, take calculated risks, build businesses. Late in expansions, they get defensive. They raise cash. They reduce exposure to risky assets. They wait for the inevitable crash. After crashes, they buy aggressively again, acquire assets at distressed prices, fund businesses that couldn't get capital during the panic. Position for the next 7-year run. It's not complicated, it's just pattern recognition combined with patience. The 7-year cycle isn't going away. Central banks can't eliminate it, though they try. Financial innovation doesn't eliminate it, though each generation thinks their new instruments are different. The cycle is baked into the structure of how modern economies work. The question isn't whether there will be another crash. There will be. The question is whether you're positioned for it when it comes. Whether you understand where we are in the cycle. Whether you can resist the euphoria of late cycle gains and the panic of early cycle crashes. Because the cycle always repeats. The timing varies slightly. The triggers are always different, but the underlying pattern, expansion, accumulation, fragility, collapse, renewal, that pattern is constant. 7 years, give or take. Again and again and again. It's not coincidence. It's the rhythm of how economies breathe.